Stop everything immediately, right now. It doesn't matter if you're finalizing a lifetime investment or in the middle of a life-changing moment. At 3:47 a.m. GMT today, the largest debt accumulation in history reached a point of no return. If you miss what this means, every financial asset you rely on, every bond, currency, or assumption of stability, could vanish before you realize it. At that precise time, the Bank for International Settlements, the Central Bankers Bank, issued an emergency update that should alarm anyone holding debt-backed assets worldwide. Global debt has hit $347 trillion. That sum, spanning sovereign bonds, corporate borrowings, mortgages, and derivatives, cannot be repaid at today's rates, cannot be refinanced sustainably, and cannot be unwound without crashing the entire financial architecture. This isn't just a figure, it's 4 times global GDP. It's more than all debt accumulated before 2010. This leverage guarantees that when the bubble bursts, it will erase not just portfolios, but currencies, banks, and governments. According to the BIS, the bursting is no longer a theory, it's arithmetic. It is unavoidable, and the early stages are already unfolding, invisible to most until collapse becomes undeniable. Yet what's truly alarming is that as debt reached this extreme, the bond markets meant to trade it have been quietly breaking down. Liquidity, the ability to buy or sell bonds, has dropped 73% since January 2024. Trading volumes are down 68%. Bid-ask spreads have widened 340%. The mechanism that allows debt markets to operate is failing. You cannot sell bonds without buyers. You cannot price them without trades. When liquidity dries up, debt markets seize. This breakdown isn't random. Data analyzed by researcher Zoltan Pozar shows liquidity plummeted as central banks began coordinated rate hikes in 2023, a deliberate tightening that pulled support from under $347 trillion in debt. Synchronized rate rises explode debt costs globally, triggering defaults, which freeze lending and paralyze bond markets. But here is the catastrophic trap. Central banks cannot cut rates to revive liquidity without igniting hyperinflation that destroys currencies. They are stuck, deflate the debt bubble with high rates, or destroy monetary trust with printing. Both paths lead to systemic failure. Both explain what gold and silver have been signaling for months. While analysts watched prices, they missed the patterns. Gold breaking above long-term resistance, volume surging in Asian hours, physical premiums detaching from paper markets. Silver's message is clearer still. The gold-to-silver ratio has crashed from 87.1 in 2023 to 64.1 today. A plunging ratio signals that experienced capital is fleeing monetary assets for real assets before currencies fail. Crucially, both metals are moving independently of stocks, bonds, and currencies. They are pricing scenarios traditional assets ignore. A world where $347 trillion is unpayable, bond markets break, and central banks hit mathematical limits. This morning's BIS report confirms those scenarios are already here. Its analysis shows that by 2027, debt service costs in developed economies will surpass total tax revenues if rates stay put, not new spending, just interest. When governments cannot cover interest with taxes, they face default, hyperinflation, or restructuring that crushes creditors. Each choice annihilates bond markets. Each confirms precious metals as the only store of value that outlives monetary collapse. The crisis spreads far beyond governments. Corporate debt ratios dwarf 2008 levels. Household debt relative to income is at all-time highs. Financial system leverage exceeds every pre-crisis peak. $347 trillion across all sectors is now unsustainable just as liquidity vanishes and central banks run out of options. This isn't a cycle. It's the failure of the debt-based system built since W2. Systemic failure triggers a transfer of wealth from debt asset holders to holders of real assets. Gold and silver aren't rising on inflation fears alone. They're rising because experienced investors see that $347 trillion cannot be repaid, bond markets cannot function, and central banks cannot fix arithmetic with policy. This isn't speculation, it's preservation, shifting from debt-based to asset-based money. Right now, central banks are trying to deflate the bubble they created without causing total collapse. But math makes controlled deflation impossible. Each month rates stay high, more debt becomes unpayable. Each month liquidity falls, more institutions face crises. Each month metals outperform, more capital flees financial promises for real assets. The shift accelerates. Debt stress forces, asset sales, reducing liquidity, making refinancing impossible, causing defaults, which increase stress. Meanwhile, metal buying tightens supply, raising prices, attracting more buyers, further shrinking supply. Debt markets spiral into deflation while metals spiral into inflation. Each spiral fuels the other until the debt system collapses and metals become the primary store of value. Leaked IMF modeling shows the deflation spiral becomes unstoppable when global debt costs exceed 40% of economic output. Projections point to Q3 2025. That, I guess, when debt service consumes nearly half of global output, when sustainability becomes mathematically impossible. Precious metals are positioning for that certainty while bonds pretend it won't happen. Next, sovereign borrowers will buckle as interest outruns taxes. Government defaults will trigger banking crises where sovereign debt is held. Corporate bond markets will freeze. High-yield refinancing will fail, wiping out pensions. Mortgage markets will collapse as payments become unaffordable, crashing real estate. Banks will face liquidity runs as loans sour. Central banks will choose between money printing to save banks or allowing collapse to save currencies. Either way, currency systems will fail through hyperinflation or deflation. Precious metals will emerge as the medium of exchange and store of value afterward. This progression is inevitable. $347 trillion cannot be sustained with broken bond markets and policy traps. Only timing and scale remain uncertain, and time is shrinking. Leaked analysis from Deutsche Bank points to major bond market disruptions, starting Q2 in 2025, as refinancing peaks and liquidity vanishes. That gives 6 months to prepare, 6 months to understand what gold and silver signal, 6 months to move from financial promises to physical assets before the $347 trillion debt system reaches its end. Metals aren't gate T predicting. They, upon repricing the mathematical present, most ignore until it asks too late. $347 trillion in debt. Bond liquidity down 73%. Central banks trapped. Metals breaking resistance as traditional assets fail. This isn't volatility, it's system transition from debt-based to asset-based money. The question isn't if it happens, but whether you heed metals in position before everyone sees it. Once obvious, there will be no liquidity to sell debt assets and no metals available at sane prices. The crisis is no longer quiet. Today's BIS report made it unmistakable. Bond markets are cracking, liquidity is gone, central banks are cornered, and gold and silver are signaling what follows. The countdown began at 3:47 a.m. GMT. Pay attention to what precious metals tell you. They already know the ending.